brought up.
Thank you very much, Mr. Chairman. Ms. Lubin, with Senator Menendez, I introduced the S3990, the Insider Trading Prohibition Act, which would finally define the offense of insider trading by making an offense for those who contribute to a securities market rigged in favor of the well-connected. Legislation focuses on providing everyday investors with a fair shot at seeing some returns. How would securities regulators, professional traders, and retail investors all benefit if Congress were to clearly define the standards for insider trading liability?
Thank you, Senator, for your question. And NASA supports your legislation, the Insider Trading Prohibition Act. We think it's important that there's clarity so people understand what is and what isn't insider trading. And insider trading, in my experience, is a very significant inhibitor on investors' ability to make money, because if somebody has information about what's going on, they'll trade ahead of the investor's ability to trade because they've got information that's not out in the public market. And that situation really disadvantages individual investors. So we think it's very important that people understand what is and isn't covered under insider trading, and that it gives the regulators clarity, the prosecutors clarity, and the industry clarity about what they can and cannot do.
Well, thank you. Ms. Walsh, the big issue is platforms for retail investors to trade cryptocurrency operate outside of the securities regulatory structure. None of these platforms are registered with the SEC or a state as a broker-dealer or a securities exchange. Instead, they rely on state money transmission licenses. And this regulatory approach strikes me as untenable because it's implausible that not a single one of the assets listed on these platforms is a security. How would getting cryptocurrency trading platforms registered as broker-dealers or exchanges help security regulators do their jobs? And how would registration result in stronger investor protections?
Thank you for that question, Senator. The federal and state securities regulatory regimes that exist in the United States have fostered investor protection and the integrity of the market over the years since they have existed. So bringing crypto and digital assets into that space of regulation could have extraordinary value for consumers and for the markets themselves. To the extent that you have disclosure, and our system is based on disclosure, that's full and fair and not misleading, that adds value to our securities markets.
Thank you very much. Ms. Lubin, with Senator Grassley, I've introduced S2147, the Stronger Enforcement of Civil Penalties Act. And this legislation would increase the size of the penalties the SEC may impose and authorize the agency to triple the penalty cap for repeat offenders. The recent cryptocurrency meltdown has revealed a shocking number of Ponzi's and frauds, even among the largest participants. And the scale of the damage is staggering. For example, an unlicensed crypto bank called Celsius has failed and owes its users more than $4.7 billion. A crypto lender called Voyager is in bankruptcy, and its liabilities are in a similar range. Thousands of customers have had access to the money frozen, and they are at the mercy of a long and uncertain bankruptcy process. How would this legislation empower the SEC to better protect the investing public from these kinds of bad actors who may defraud and scam them out of their very hard-earned money?
Thank you, Senator, for that question. We think it's important that regulators have multiple tools that we could use in order to try and protect investors. And the idea that penalties could be enhanced and fines could be higher for recidivists and for other actors, I think is another tool that we will have to discourage bad behavior. I think part of the problem that we've seen over the years, and I've been doing this for many years, is that a lot of the industry considers penalties to just be the cost of doing business. And those penalties need to get into the range where they're high enough that it provides a deterrent for bad behavior.
Well, thank you very much. Just one final point, and that is that we've noticed that a lot of private equity firms are going down the ladder in terms of income and disposable income particularly, not just the very rich, but down to what they call the mass affluent, which is an interesting terminology. So it raises the question about who counts as a retail investor, and it's blurred the lines between public and private markets. Any comments on that?
Thank you, Senator, for that question. I think that really points out the issue we have with the difference between the public and the private markets. And the private markets are not transparent. Investors don't get the kind of information they get in the public markets. But because of the accredited investor definition and the really low dollar value that's attached to that definition that has not been modified in the past 40 years, there are investors who are able to avail themselves of the private markets that really should really not be in there. They should be in the public markets where they have a much better chance of making money, there's more liquidity, and there's much more transparency and less complexity into the investments that they're purchasing.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Senator